the price of gold continues to soar higher. Now, in this video, I want to break down gold. I want to look at some of the fundamentals and why we're seeing gold prices move higher. But I also want to do something so critical. I want to adjust the price of gold going all the way back to the 1970s. When you adjust for inflation, the price of gold, you realize it hasn't moved that much. This is something that I do continuously as I adjust prices because they get distorted when you look at the bigger picture from all the way back in 1975. I'll give you a brief history on the Bretton Woods, the Nixon Shock, and then price of gold. But I also want to look at what China's doing and why they're really driving a lot of the price of gold. We probably will see continued moves higher in gold prices, especially with a wall of inflation and what's going on with inflation prices coming up. Let's jump in. I'll break down the price of gold and why I'm kind of iffy on getting involved in gold, even though I already have some. I have a bunch of silver. Anybody who's been following me for any period of time. Let's jump in. Let's look at some charts. All right, if you're just finding me for the first time, thanks so much. Make sure to subscribe. You'll find links down below to my Substack. Now, if you're finding me on my YouTube channel, I am prioritizing Substack simply because it's a much better platform than YouTube. Two things to note, right underneath the DH Taylor analysis, you're going to see two things there, notes and chat. Chat, for those paid subscribers, this is a great way to get in touch with me, direct communication, and I do a lot of things in that chat. So make certain to, if you have any questions, feel free to send them my way. I get about 2 or 3 chat messages per day, so I've been real good about getting back to them as quickly as I can. I try and get them in the morning. Nonetheless, thanks so much. The channel is growing rapidly. Let's take a look at, this is gold, and this I push everything back to the most recent financial kind of event that we've had, and 2020 is basically where it is. But if you look at late 2023, 2022, September, November, gold was trading about 1,700, a little less than 1,700, about 1,600, and it's more than doubled in price in 2 years' time. That's huge. We are now at 3,400, so a 100% gain in the past 2 years. But what happens if we inflation adjust things? And I do want to take a look at that in a minute. In the meantime, these are some things that I've been finding on the internet as to what's going on. The top one, assets under management, I found a nice article, but these are company filings, World Gold Council, some articles that I found on these things. And as you can see, there's been a big jump higher in assets under management, that purple section there. This is a bit misleading because if the price of gold doubles, so does your assets under management. Just pointing that out. But they are still seeing inflows into these ETFs. And these are specifically Chinese gold ETFs. That's important. One of the things you need to understand is how the financial system works in regard to the central banks. China themselves, if a company deals business with the United States, they're not allowed to necessarily exchange US dollars themselves. They have to do it through the Central Bank of China. By doing that, the Chinese central bank then controls these excess flows. That is important because then they decide what to do. And there's been a handshake deal with the United States for some time that the Bank of China would buy US Treasury debt. Now, of course, there's a trade war. So what is the incentive of the Chinese to buy U.S. debt if they're at war with the United States? So one of the things that Chinese are doing, the Central Bank of China, is increasing its gold reserves. So instead of buying U.S. treasuries, they're buying gold. So there's this constant flow of treasuries that the Bank of China has been getting. They have dwindled their overall holdings significantly. It's about 3, 4, 5 years ago. They peaked out at about 1.2 trillion in US dollar reserves. They're down to about 785 billion at this point. So the Chinese reserves have diversified. Now they're not diversifying as much. out of US or other currencies as they are into gold. This is one of the things that has been pushing the price of gold higher. This is creating a bubble for the Chinese. They're the ones who are actually chasing this. You don't really hear too much information here in the United States. And I do have some charts to kind of point out why this is. Gold is something you trip, you fall, you find some, you throw it under your mattress. I have silver. I also have PAX-G USD, which is a gold crypto. Over the past year, I've been pushing into that. About 15 months now, I've been pushing into that, and that's done very well. But I keep getting real close to hitting a button to get out. Let's do a quick Econ 101. How did we get where we are? What's happening? Everything starts with Bretton Woods. This is an agreement out in, I think Bretton Woods is in New Hampshire. Bretton Woods is actually a city, town, village, whatever you want, New England, United States. After World War II, immediately after World War II, of course, actually, I think it was prior to the end of World War II when Bretton Woods they sat down and said, let's figure out what's next once we're done winning this war. Europe was in shambles, of course. The United States was this manufacturing powerhouse. So the United States of America agreed to go ahead and produce everything that was needed to rebuild Europe and then become trade partners with Europe. That infrastructure was basically fine. Price everything in US dollars. The US dollar would effectively become the de facto reserve currency. That's how the United States of America became the powerhouse it was. One of the factors. There's many, of course. The political system allowing that to happen is one of those things. Then we got the Nixon Shock. Okay, so one of the things Bretton Woods did was it pegged the US dollar to gold reserves. And the United States used to have a certain allocation of gold. The problem with this is we would see price shocks for various reasons throughout the 60s and things like this, early 70s. And so Nixon himself basically said, we need to decouple the U.S. economy, the convertibility of the U.S. dollar into gold because it was pegged. And therefore, there was a lot of pressure and this really was unsustainable in the long run. A gold peg, a peg to something that is the supply and demand could change rapidly and could be cornered, wasn't effective for an economy that they wanted to expand. So Nixon said, we're done with the gold standard. He effectively yanked the United States of America out of the Bretton Woods Agreement in a way, without going too far into it. If you look at, it was 1971, 72 that Nixon made these moves and nothing really happened. Then in 1973, gold started moving. Now, a lot of the charts I have start in 1975. I don't have any data points for actual gold starting in 71, 72, 73. The earliest I could get these data points was 75. It's still significant. But I do want to break down that now that the United States is decoupling a second time out of the Bretton Woods, trying to not be the de facto world superpower that it is. And I think we're shooting for mini power at this point. This gives you an idea of what's going on. China's central bank is pushing more and more into gold versus what it was doing before. Remember, any company doing business with the United States in China, they get these reserves. They give those reserves to the Bank of China. China then converts them. The individual banks, your company, Shanghai Incorporated, does not go to the local HSBC, Hong Kong Shanghai Banking Corporation, and exchange that in the interbank system. Instead, any excess reserves, HSBC Bank, of course, would turn to the Bank of China and say, we got all these reserves. We keep getting reserves. Do something with it. The Bank of China will do that exchange for those individual banks inside China. All right, that's an important concept, that flow, because this gives China the control over reserves, what is done with those reserves. And what they were doing is buying U.S. debt. And it looks like they've stopped, but instead mopping up and getting into gold. Up until a certain point. TIX report. This is one of those reports that is only important when it becomes important. As an FX hedge fund manager, I probably looked at this thing like 3 or 4 times. Like once a year, I'd be like, oh, let me check in on that. And it's always steady as we go, steady as we go. Treasury international capital flows. All right, what's going on in the treasury markets? Who's buying the treasuries? Foreign purchases, the one down below, you can see alarm bells were going off. All of a sudden, however, the latest report, which came out on the 16th of April, just a couple days ago, 6 days ago, we saw a resurgence of foreigners purchasing treasuries. Now, this is for the month of March, so we don't actually have April's data points. And April, of course, was when the liberation of the United States occurred, so we could easily see a shift right back downward. This is going to be important. So the foreign purchases is exactly that. What percentage of foreigners are actually buying this? This is important. Foreigners own about 22% of all the debt, which is at 36.8 trillion at this point. 9 trillion of that is foreign owned. If all foreign debt got dumped, citizens within the United States of America would have to come up with $9 trillion to take over that debt. So we do rely heavily on foreigners. Since the Bank of China is no longer buying our debt and buying gold, you can see the transition, why we're seeing interest rates moving higher and higher versus gold moving higher and higher. This is how that functions. Treasury international capital flows. Capital flows is exactly that. It's just money itself. And then are they buying that debt? This is one of those indicators that I check in on once every year or so. It never is important until it's important. And then it shows us data points that we're like, oh, okay. Gold versus the money supply. Everything is geared on the money supply. If we had a flat money supply, we would have flat across the board. Gold prices probably wouldn't move much. Stocks would only move because they entered new markets, international markets or something like this. So understanding that the money supply itself expands and therefore prices expand is an important indicator. In this case, I have taken the money supply and the price of gold. I went all the way back to 1975. Again, that's the only data points I could get for charting purposes. And I looked at the real money supply. When we use the word real, all in capitals, we're talking about inflation adjusted. So if you look at the inflation adjusted money supply, we've seen some big spikes. Obviously, in the 1980s, we had a huge inflation spike. Just celebrated my 57th birthday on Sunday. Thank you very much for the thanks or congrats on that. I remember the 80s. I was a teenager. So we've seen gold prices moving up higher and higher from time to time. Mostly, however, the economy of the United States just continued forward and left gold behind. Now it is China that is pulling gold upward. Doubtful that it will cross over the money supply. But all things are relative. This is gold versus the money supply. This is the S&P 500 in blue versus the same green money supply. As you can see, you can probably see where I'm taking this. We have seen some decent moves. And for the record, S&P 500, all the way back to 1975, inflation adjusted. So the money being the fuel, rocket fuel for the United States of America, you can see what's going on with capitalism here in the United States on an inflation adjusted basis. It's not really as big of a move upward when you adjust and look from one perspective all the way back in 1975. Now, it should be troubling to you that you're looking at what's going on in the dot-com era right there smack in the center. Another thing is 2008, kind of take a look at that. Without going too far into economics on that, in 2008, of course, we had the financial crisis, a big move downward, and it really took a bunch of years before we started moving back upward again. 2020, of course, was you saw a blip downward, then a big surge from COVID, when that surge, of course, came from the Fed pushing it and the response. Finally, gold versus the S&P 500 since 1975. Generally speaking, gold has underperformed. There have been the 1980 surge. There was another surge starting in 82. Things got pretty close in 87. Then gold just basically got forgotten. For the 1990s, one thing, a bullet point for anybody who's kind of looking what's going on here, all money in the world rushed into the dot-com era. Period. So we saw this big, huge surge in the U.S. economy because of the new economy, as we used to call it. This is also the only time Nixon one time got a balanced budget. And I can't remember the exact dates off the top of my head. Clinton was the other one. When Clinton handed over the economy to Bush, he handed over a surplus. The only time in American history when that basically has happened. And then it was all downhill. As you can see from there, the S&P 500 fell because of the dot-com era. Now, Clinton cheated. He had a good economy. You can take that for what it's worth. He didn't really create the dot-com era. He just happened to be president during the dot-com era. And that's cheating. But the dot-com era, of course, popped. On an inflation-adjusted basis, you can see what the moves were like for the S&P 500. We saw another surge in inflation because the Federal Reserve was pumping money into the system. Gold in the yellow pushed higher. If we see gold pushing all the way up to the blue line, one of two things happened. We got a wall of inflation so massive that the price of gold has surged so much, while simultaneously this has to happen. The inflation just absolutely cripples the economy beyond repair in a 1929 style. And the blue line would move downward. Is that a possibility? Sure. Everything is always on the table. Absolutely. Is it a probability? I think someone's going to capitulate on their policies, and I don't think the Republicans are going to pass the legislation that they're looking for inside the budget. And because of that, we will see capitulation on this process that is being unfolded here in the economy, that they're going to have to back out, and it'll be a big L. So, possibility, yes. Probability, not as likely. But we will keep a close eye on that. That is something that when you take the S&P 500 and you take gold and you look back at it from 1975, that critical period, or 1970, that critical period when the United States removed itself from the gold standard, you see how the economy took off after inflation was taken out and the aftermath beyond that. These are important factors to encapsulate if you are going to be looking at any kind of investments whatsoever. Where does that leave us, broadly speaking? GLD ETF. If you believe that gold will continue forward, that would be an easy ETF for everybody to get involved in here inside the United States. I think other countries you can get involved in as well. China, very likely, will continue increasing their gold reserves. At the very least, until they've diversified and then need to find somewhere else to put this money. Number one. And that will continue to push gold higher. Then they're probably going to play the propaganda game turning to the Chinese, who culturally and historically sort of, I want to say, revere, and I'm not trying to be racist or anything like that. Culturally, they like gold a lot more than we do. They revere it in a way that's different than we do here in the United States of America, and that's just, it's just to me, it's just a metal in the ground, but it does have some store of value, and that value is appreciating. I look at it for exactly what it is. It's just an asset class. I dismissed everything. It's just that. Stocks, asset class. Real estate, asset class. It's meaningless to me. But that gives you a concept that the Bank of China could easily then turn to their propaganda machines, if we want to call it that, and tell everybody, hey, get aboard on this gold thing. It's really wonderful. And it becomes a race for gold moving higher and higher. At the same time, the United States, take a look backwards at those charts that I had presented to you. We're about to see a wall of inflation. Would we see a 1980 style wall of inflation? For the record, I have a video coming out tomorrow specifically regarding inflation and how this is going to break down and what you can do to trade that inflation here in the United States. It isn't just a 10% tariff. There's terms of trade with currencies. There are then the secondary. A company orders a product and the price inside that moves up by 10% because of a tariff. You start seeing ripple effects through the manufacturing process where prices can keep moving higher and higher. Then the Federal Reserve has to kick in. Keep this number in mind as well. This is so important. In the 1980s, Paul Volcker pushed short-term interest rates to 20% target. I think he was at 20.5 was the actual number, was the high. Absolutely decimated everything. Specifically, inflation. We're probably entering that period of economic history right now. You can let that sink in. Make certain to follow down below. Jump over onto my Substack. You can subscribe or follow there. If you are looking to get involved in gold, GLD ETFs are an excellent way to do so. Me personally, I already have some form of gold because of my PAXG USD cryptocurrency gold, and it's doing wonderfully. But I'm really looking to protect the capital gains that I've gotten in this. So I'm looking to instead buy puts on GLD ETF to protect the downside once we see a move. But I don't think we're there just yet. Nonetheless, I wanted to break down gold as an investment on an inflation-adjusted basis so you can get a practical look at it. Because if you just look at the unadjusted levels going all the way back to 1975, it looks astronomical. On a statistical basis, gold is only up about, I think it's 3.4 times in value on an inflation-adjusted basis since 1975. Stocks, 14 times inflation-adjusted. Let that sink in. Make certain to follow. Hit up my Substack newsletter. We'll see you in the next video.